For those of you that are not familiar, the American Evaluation Association is a professional association on evaluators devoted to the application and exploration of evaluation as a profession. The Social Finance Topical Interest Group is called Social Finance TIC for short, and we are a group of AEA members who are interested in the topic of social impact measurement and management and exploring the interplay between the social and financial return of investment. We have very exciting webinar today focused on organizational learning of impact investors. Today's webinar will be, the panel discussion will be handled by Juhi Ran. Juhi is the Director of Impact Principle at GIN and serves as the Head of Secretariat for the Operating Principle for Impact Management. In her role, she leads the overall strategy, direction, and management of the impact principles, drives the growth and programming for the signatory community, and collaborate with ecosystem partners to deepen the rigor and credibility of impact management practice in the financial industry. With this introduction, please turn over the floor to Juhi. Thank you.
Thank you, Ichiro. Thank you for the invitation and the partnership. Really happy to be here. And I'm also really excited for the greater connection that's being made with the evaluation and the impact investing IMM community, because I think we have a lot to learn from each other and also benefit the field broadly by bringing together the best practices from each of the disciplines. So thank you so much for the work that AEA Social Finance TIC group is doing. If you go to the next slide, here's a very quick overview of the agenda for the session today. We'll begin with a very brief introduction of the impact principles and Principle 8, which is the focus of the conversation today for those of you who may not be as familiar. And then we'll dive into the discussions of 4 primary questions, starting with a very important question of how impact investors assess their achievement of impact and identify lessons learned to inform continuous improvement. And I'm really grateful to have amazing panelists today who will give a great case examples of actual IMM frameworks within their organizations. And then we'll also get to dive into some of the challenges, what role third-party research evaluations and independent verifications play in the process of review and learning, and also dive into how to build a culture and system of continuous and deeper learning and improvement within the organization so that practice continues and it's not an ad hoc process. So while we'll be using impact principles as a primary context for the conversation today, we wanted to recognize a few other key frameworks for IMM for impact investors, specifically the UN Sustainable Development Goals, 5 dimensions of impact, which is now at the Impact Frontiers, and the IRIS Plus, which is a generally accepted impact accounting system used by many impact investors. These are familiar by many impact investors and hopefully to the audience as well. And we'll be hearing from our panelists of how they are integrating these tools and standards into their own IMM system within the organization. They are really part of a larger responsible investing tools and standards in the market, but really represent the most widely adopted and impact-focused frameworks that are helping to bring much-needed coherence and standardization for impact management practice today. So impact principles are a global standard for integrating impact throughout the investment lifecycle. It was developed as an initiative to prevent impact washing by bringing greater discipline and transparency around what it means to be an impact investor in practice. It was launched by the IFC in 2019, is now hosted at the GIN, and has over 180 signatories across 40 countries today, representing about 530 billion in impact AUM, so a very significant share of the entire impact investing market globally. So when the signatories sign on to be an impact principles signatory, they are really committing to both transparency and discipline of aligning their impact management process to each of these 9 principles. It is an end-to-end framework of best practices from strategy all the way to exit, as well as continuous improvement from lessons learned, which is where Principle 8 comes in and the focus of discussion today. But before we dive into Principle 8, I wanted to really emphasize one of the most important and distinguishing requirement of the impact principles for our signatories. So Principle 9 requires signatories to commit to annually disclose their impact management process in alignment with each of the 9 principles of impact principles, and also conduct a periodic independent verification of this alignment. And all of these annual disclosure statements and independent verification summaries are published on our website, which really brings incredible level of transparency that promotes and prevents impact washing in the sector, but also promotes development of best practices and learning by bringing comparison, benchmarking, and peer learning in a very public forum. So Principle A requires signatories to review, document, and improve decisions and processes based on the achievement of impact and lessons learned. It goes beyond positive expected impact, which we typically measure, and really look at unexpected and negative impact as well. So it's really about making sure that all of the IMM activities are actually improving impact efficacy and effectiveness, and all of the capital that it's helping to mobilize and deploy are ultimately driving actual impact outcomes, and not really just about impact measurement for measurement's sake or capital going to financial returns with mediocre impact outcomes. So what does the state of practice look like today? Here's a brief summary of what we are seeing as more common versus emerging practices according to a very preliminary analysis of about 150 signatory disclosure statements from the past year. This is based on what signatories cite in their disclosure statement versus actually interrogating their processes and documents as a secretariat. So take this as a more of a directional high-level insight versus a scientific or statistically rigorous analysis or evaluation that many of you may be more used to from the AA audience. So as a common practice, most signatories cite that they are incorporating findings to improve investment process and IM frameworks, which is good. Some do it more systematic way, and others may be more anecdotal and ad hoc in their processes. Majority are reviewing their investments and impact performance at least on an annual basis, and we actually see about half doing it on a quarterly basis. So those are more common practices that's happening today around Principle 8. We are seeing a growing trend of comparing estimated versus actual impact, reflecting and learning from evolving industry standards and frameworks, which is critical given the rapid evolution of the standards in the market today, and they're incorporating it to adjust their own impact practices and using case studies as a process of learning in their process. We're also really encouraged to see some signatories using post-exit reviews. So this is after they've exited a year or two after, to use that learning and see whether impact is sustained, and also conducting more independent evaluations, whether it's internal department or third party of their investments and investment processes. Where we are seeing more gap in the field is reviewing really unintended impacts or impact drifts, and also looking at customer or investee level with a surveys or a way of looking at impact outcomes at a beneficiary level. So this is some of the state of practice that we are seeing amongst our signatories. And today we'll actually hear from our panelists, some, if not all of these practices in their actions. With that, it is my pleasure to invite and introduce our panelists today, who bring incredible level of IMM expertise from a very diverse group of asset managers, as well as a large DFI in the world as well. So welcome, and I'll ask you to just say your name and your role and organization briefly and come on the stage. So why don't we start with you, Deepa?
Thanks, Juhi. Hi, everyone. My name is Deepa Chakrapani. I lead the team that is responsible for impact reporting for IFC across the institution. And it's been a pleasure working with both the AEA and OPIM. I'm very excited to share IFC's experience on Principle 8 and beyond. Thank you.
Great. Luba?
Hello, everyone. Luba Shabal. I'm head of Closed Loop Partners, Impact Measurement and Management, and it feels great to be here. Thank you.
Alice?
Hi together, my name is Alice Hundler and I'm part of Trill Impact, working as an impact manager from the Munich office.
Thank you. And Lila?
Hi, everyone. I'm Lila Vosco. I'm the Director of Impact for Microvest Capital Management, and I lead our impact measurement and management practice. And thank you so much to AEA and the Operating Principles for Impact Management for inviting us to this webinar today.
Thank you. So to get us started, I would like to ask each panelist to take about 5 minutes each and provide a brief overview of each of your organization and the IMM frameworks. How do you assess achievement of impact and identify and use lessons learned to continuously improve your strategies, decisions, and processes? And if you can share, what's your priority learning agenda for IMM right now? We'll start with actually Lila at Microvest, and then continue with Luba at Closed Loop. They have more targeted impact themes as well as asset classes compared to Deepa at IFC and Alice at Trill Impact. So we'll start with you, Lila.
Thank you, Juhi. I'll take it over. Before we move to introduction, if I can please just ask the audience to briefly turn your attention to Microvest's legal disclaimer. If you're watching a recording of this webinar, please spend as much time as you like on this slide, but beyond that, thank you. Next slide, please. So at Microvest, we are an emerging markets focused asset manager. We specialize in private debt investing, and our core strategy really focuses on allocating private debt to micro and SME financial institutions that are providing sort of productivity generating financing to these underserved micro entrepreneurs and small businesses in emerging markets. Our primary impact focus is on financial inclusion, and specifically, we're looking to invest in companies that are either, supporting access to financing for underserved businesses or that are facilitating financial health for their customers. And, this can be done through the provision of savings, insurance, money management tools, sort of education or training. So far, we've dispersed about 1.7 billion to support financial inclusion since inception, and we'll be launching a new climate justice fund focused on climate change mitigation later this year. So this slide here is showing Microvest's new impact framework, which we actually just publicly launched a couple months ago in March, following this 10-month period of development and testing. And we actually decided to go down this path and develop a new impact framework for a few reasons. One, we really wanted a new system that sort of reflected our evolved thinking around impact, especially around this desire to pivot our practice away from outputs-focused reporting to more outcomes-focused assessments. We really wanted to sort of better meet the market where it was today, also from an IMM standpoint, and we wanted to better systematize how we were assessing, measuring, and managing impact across the portfolio. And if you can see here, we incorporated a very deliberate feedback loop into the design of this framework, where the impact goals, which includes our theory of change and our thesis for the portfolio, sort of determines the criteria for investments, what we want to measure, what the measurement approach is going to be, and sort of that would influence the learnings and how it impacts the rest of the processes across our framework. So because this webinar is focusing on Principle 8, I'm not going to touch on, the other components of this framework, but specifically what we're trying to achieve with this sort of measurement, monitoring, and learning component is ultimately, one, we want to spot trends and see if we can identify any goal-specific gaps in our portfolio that can be addressed either through target setting or through specific priorities that we can set from a portfolio allocation standpoint. Because our framework is very new and young in its maturity, we'll be using this initial feedback process to sort of get reflections from the investment team on how they're finding these new processes and templates that they're having to action with this new framework. And sort of what we want to do is we want this learning process to facilitate, open discussions with our staff about what's working, what's not, and ultimately what can we do to influence strategy, process, and goal setting from this standpoint to get to where we want to go. So these are real live examples from our most recent portfolio impact review. These are charts that reflect portfolio level metrics across 2 of our flagship private debt funds, and they are based on self-reported data from our portfolio companies, and of course exclude any company that did not report on that data. And I think for the sake of time, I'll just touch on one example from this slide. Of course, if anybody wants to discuss any of the other ones, I'll be so happy to chat after the webinar and sort of pick your brain as well. So if we can please look at maybe example 2, since it's the most dramatic looking chart. This chart is showing, the trend in the number of savers depositors that's served by our portfolio companies on a year-over-year basis since 2019. And this is a metric that we're tracking under the financial health category because we do want to see, one, how many end borrowers are formally saving through our portfolio and how many people are setting up new accounts. And this chart here is actually showing a 71% decrease in the number of savers and depositors served by our portfolio during this time. And sort of this decrease is even happening despite the percent of deposit-taking institutions in our portfolio increasing over that same time period. And, I can guarantee you our investment team was not investing with the intention to tank the number of savers depositors throughout this time period. But why I included this example, because it's sort of reflective of this bigger trend we're seeing in that, for Microvest, our investment and impact thesis is set at the strategy and at the fund level. And so that determines the impact that the portfolio is seeking to have, which also influences the type of companies that we're targeting for investments. And so we qualify our portfolio companies as impactful, at the outset. We know the types of institutions we're looking to target that are serving a segment that's untapped by global banks and that's also meeting the demand of underserved customers. Then our due diligence focuses on sort of financial and credit considerations of the company and on ESG risk. And then we would focus the majority of our monthly and sort of quarterly portfolio monitoring on financial and credit considerations and compliance with covenants. So when it came time for us to actually look at our impact metrics, what we were finding was that it was a bit hard for us to attribute, a deliberate narrative to our impact focused metrics, since these trends were primarily a byproduct of investment decisions that were made based primarily on financial and credit considerations of the portfolio. And, we'd see this across some of our other metrics in that on a year-over-year basis, these impact metrics would go up and down like this, but it wasn't because of anything that we were doing proactively from an impact perspective to move them. And so it's also important to note for us that, there's never going to be a scenario where we say, let's boost our number of savers, depositors in the portfolio. So we're going to go and find a company that sort of satisfies that metric. As an asset manager, we do have to, one, make sure that the company can meet the financial risk return thresholds that we've set for the portfolio, and we'll always prioritize that. But what we're trying to actually do is we want to see if we can become more intentional about the impact that we're achieving across the portfolio beyond the impact that's sort of given as a result of the strategy. So what we're doing to address this is we're going to be adopting this near-term give credit approach, which means beyond risk return, we're going to give credit to a company that can demonstrate progress toward one or more of our key focus areas, which will be determined based on the outcomes of our impact review, which determines, what we're looking to prioritize. And I think overall, our priority learning agenda for the next year will be focused on, one, what we can learn post year one of operationalizing our new impact framework, and also, to see if our give credit approach can actually drive a more intentional impact focused narrative to the social metric trends we're seeing across the portfolio. Thank you.
Thank you, Lila, for just a real transparency in sharing this portfolio example and your learning. And it's great to also see the 60 decibels customer level insights and really impact being integrated with financial performances in your assessment and not in silos. So thank you for sharing that. Luba?
Thank you. CLP, Closed Loop Partners, is at the forefront of circular economy. So I think there is one stat that I want everyone to take away from this is 70% of global emissions, they come from how we extract, manufacture, consume, and dispose products. So this is the linear economy that we operate in today. We Closed Loop Partners, we operate in materials management space and aim to keep materials in circulation for longer to minimize dependency on extraction and at the same time minimize landfilling. CLP is the 3 business divisions. So we innovate, we invest, and we operate. For the purpose of today's webinar, we'll really focus on the investment arm of the firm. So within that, we have early stage ventures, it's private equity and catalytic private credit strategy that's called Closed Loop Infrastructure. So through those three very distinct strategies, we invested in over 80 companies today. And our operational focus is in North America, primarily US. We created the solid framework that's called 4 Universal Steps about 2 years ago now. And what enables learnings for us is that there is a continuous monitoring and active management of our portfolio companies' impact. So IMM, which stands for Impact, Measurement, and Management, is strategically integrated in every step, from the fund structuring, step 1, to diligence, hold-in phase, until exit, which is step 3, and step 4, which is really about learning and sharing what we learned. So the continuous integration is key to enable learning for us, and Principle 8 is evidenced in every of those steps. So I'll highlight one example on each of those 4 steps. Set strategy is step number 1. One of our 8 funds has impact-linked carry. It is a catalytic private credit fund with a very clear codified intention to keep in circulation 500 million pounds of polyethylene and ethylene and propylene plastic. So those 2 types. And this impact target is documented in LPA. It's documented in IPS, which is investment policy statement, because LPs of that particular fund, they identified priority in terms of where they want us to spend money. So we make it work, and we're really proud to have a fund, one of our funds, with such structure in CLP family. However, if you think of carry and impact-linked carry and try to compare those, for the carry, there is a standard, and there are auditors who validate your IRR calculations. There's even IRR formula in Excel. And even so, IRR today can be gained. Now, looking to impact-linked carry, we love the concept. We think the idea and intention is very clear and authentic. We want to incentivize the team to the right direction. But there is no standard and how to define and calculate impact-linked carry. So we came to realize that the industry is really not there yet for us to continue include that in the fund structuring. So going back to our funds, we build the process to track towards target, and we report to LPs quarterly. But then all those questions came to ourselves. Are we doing enough in this process? Do we need third party to validate what we do here? Was the target really ambitious yet realistic? And who is there to tell that it was ambitious and realistic? And are we limiting our pipeline with that impact-linked carry and potentially sacrificing returns? Are we hyper-focused on this one dimension of impact? But we in our field know that there are multiple dimensions to impact. So by focusing on one, are we potentially adding more risk to other dimensions just to meet the target? So all those questions we're still working through, but that's one of the learning on step 1. Step 2, that's our due diligence, how we integrate in investment diligence process. We were on and off with a scorecard, and we determined at some point that it doesn't really help us. So we're not learning from having scorecards, and we decided we won't do that again. It works for some, but it just, we're a very niche investor. We only invest in companies that accelerate transition to the circular economy. So just answering that one question, substitute the need of the scorecard for us. The third learning on the holding stage, which is portfolio monitoring, step 3, we built a process of regular impact data review that happens every quarter. So there is a templated document, we call it quarterly impact memo, and fund team and the impact team, we review completeness, we review outliers, expected versus realized impact, and different factors that influenced over and underperformance. So this can be, in our field, it can be seasonality effect, operational disruptions, or leadership change. And then finally, step 4, reinforce. A little less than 2 years ago, we created Impact Steering Committee for governance and oversight of our IMM system. So this committee is comprised of our CEO, of our operating officer, a strategy officer, head of impact, myself, and a rotating member, a member that changes every year. The goal is to meet twice a year, plus ad hoc for any important decisions with that group. And we review process, IMM process integration, as well as performance of each individual fund. So really having this holistic system in place that covers everything from fund structuring all the way until exit and disclosures is what really enable us to identify lessons learned and improve of them. So to sum up on fund, step 1, it's fund structuring and impact link carry. Step 2, scorecard. That is not something we decided, not something that we need to use moving forward. Step 3, the quarterly impact memos, and 4, the impact steering committee. Back to you, Yohi.
Thank you, Luba. I should also mention that aligning incentives to impact is part of principle number 2 as part of managing impact at a portfolio level. And we actually have a webinar on our website. So those who are interested around incentives, which is a work in development in the field, I encourage you to check it out as well. Why don't we go to you, Alice, now?
Great. So starting maybe with a brief introduction on Trill Impact. So Trill Impact is a global impact house with currently 1.2 billion assets under management across 3 different strategies, namely private equity, venture capital, and microfinance. And my today's focus will be on our 2 kind of private market strategies, private equity and venture capital, as those constitute the largest part of our capital under management. And I'm part of the impact team dedicated towards those strategies and hereby mainly private equity. So myself being part of an impact team, we consist of 6 professionals that at Trill Impact that work alongside the investment team with the ambition to maximize impact as well as financial returns through our investments. The PE strategy was founded, and our entire impact house actually was founded in 2019, so relatively young. And the private equity strategy is currently in the 2nd fund generation, with which we have now, across both funds, performed 36 investments to date, of which 25 are add-ons. Moving to our impact management approach on the next slide, and particularly kind of how we relate to Principle 8 of the impact principles that as a whole were really instrumental in forming our impact management process. So coming to the scorecard that you see on this slide, this is actually something that is really shaping our investment decisions. And this is particularly important as we are an impact generalist investor compared to closed-loop partners, for example. And kind of starting or briefly walking you through this model, this is a proprietary model that we developed based on the IMP 5 dimensions of impact that you can see here on the left-hand side. But we've further developed this to identify a current and potential rating score from 0 to 100 across those 5 dimensions. And for us, we'd put that a level deeper to 10 core impact aspects, which we analyze in depth throughout our DD process. As mentioned, this model is really an integral part of our investment decision and particularly helpful for us to make investments comparable across different sectors and impact themes. As a kind of impact generalist, we look at different business models that ultimately vary with each asset that we look at, and makes it possible for us to compare assets, for example, from the healthcare industry to cybersecurity or building automation. Talking about how we further develop this model as a focus, but also kind of how we further developed our impact practices as a whole. So Principle 8, I would like to focus on 2 different levels. One would be kind of the portfolio level development and improvement, and one would be the fund level development. Starting with the portfolio level, we have implemented structured touch points to review and compare each investment's impact and ESG performance. So for this purpose, portfolio companies are required to report on key impact and ESG KPIs every quarter. And in case a portfolio company is not on track or unable to achieve those goals or deviate from budget, we identify special review meetings and set them up together with management after having discussed it internally to revisit the impact performance towards those targets, but also discuss action items to assist the progress towards those goals. So that's on the portfolio level, especially kind of monitoring the progress towards the potential score that you see here. And then we also kind of foster development and improvement on a fund level. And that's particularly important as we're a relatively young firm, having established kind of our impact frameworks and continuously developing those to improve our processes. So to enhance our practices on that level, the impact team hosts quarterly strategy sessions to reflect on the lessons learned of several different transactions that we have done, but also to discuss improvements on a more holistic level to our impact management system. And input to those strategy sessions are, most importantly, kind of benchmarking exercises that we do and are on a regular basis. We monitor kind of the development in the market and discuss with our peer funds across different criteria to understand where kind of similar and investment strategy peers are standing and how they're implementing their impact management processes. And furthermore, we engage also with other partners, independent verifiers that we'll talk about later also, and industry bodies to seek advice and understand kind of what the emerging best practices are. And such examples are, for example, the round here that we see here today, from which we could also learn and are excited to engage and further develop our processes on. And with that, over to you, Joey.
Thank you, Alice. It's really interesting to hear the more targeted versus more specialist or generalist impact managers compared to closed loop. Talked about impact scoring being not as applicable for them, but for you, really impact scoring or impact rating system being very useful when you have multiple impact themes that are hard to compare apple to apple in terms of impact context. So thank you for sharing that. And it's also good to see the applicability of the 5 dimensions of impact across asset classes and impact themes in your case. So thank you. Let's go to you, Deepa. And unlike the other panelists, IFC is a large development financial institutions with a unique mandate. So, and a very deep evaluation capacity as well. So look forward to hearing your presentation.
Thank you, Juhi. So I'll just set the stage a little bit. So for us, as you know, we are the largest development financial institution in the world. For us, impact is very much part of our double bottom line. And it's the reason for our existence. We wouldn't have a license to operate if not for our impact management framework. So this is very key to us. And this is why there was a lot of excitement in IFC when the principles, when we spearheaded the principles, and now we see that growing and mushrooming. We're very excited to be able to be one of the, not just the initiators, but also somebody who sticks to the principles of the principles and actually demonstrates that in practice. So if we can go to the next slide. I'm here to talk about AIM, which is the anticipated impact measurement and monitoring system that IFC has had in place since 2018. We've always tracked results ex post, but this is a sort of end-to-end system. And it illustrates Principle 8 in operation in terms of how we review, how we integrate impact measurement and monitoring into our decision-making processes. I won't walk you through every aspect of the slide, just to say that for us, framing the impact is actually extremely important when we select our projects. So even at a pre-concept and a concept stage, we're very much looking at what is the development thesis for IFC to participate in this particular deal. And we actually look at it from a point of view of literally sitting down with the investment officer, walking them through the thesis and saying, this is the expected range within which you think you are going to, have development impacts from this operation. We split these impacts at 2 levels. we look at it both in terms of what is it that the project will actually offer to its stakeholders, whether it's employees, customers, supply chain providers, people in their forward or backward linkage supply chain. But we also look at whether there is, and if there is any contribution that this investment will make to the growth of the private sector in that country or in that region or in that subsector overall, if at all possible. And we capture these systemic effects also as part of our framework. There is a rating that is based not just on what the investment deal will offer for IFC's portfolio, but we also look at where is this actually happening. So if you are going to influence or affect your stakeholder or your supply chain in significant ways, are you doing this in a very well-developed context? Are you doing it in an underdeveloped context? Similarly, if there are systemic changes, are these systemic changes happening in an underdeveloped market or a more developed market? And that varies sector by sector. It varies depending on what you're doing in which country. And so we actually have elaborate frameworks that identify the development context for operational teams. It also identifies the stage of market development of the sector so that teams can sort of locate their investment projects in that, and projects that are obviously doing maybe a little bit less in a very underdeveloped context will score more in our framework. We then adjust the ratings very specifically for the probability of achieving those impacts, because in certain environments, the risks to development impacts are very high. And last but not least, this is one of the 4 pillars that go into the decision-making process during our investment review meetings. So in our investment review meetings, just as we would look at financial or credit risk, the financial returns, we also look at the impact score. We take into account other metrics that may be there in our scorecard. So for example, this assessment of impact does not explicitly say whether this impact is a strategic concern for IFC or not. We're not scoring whether we're performing to strategy. We are not scoring whether we're not, we're making returns. We actually have an impact score that is looked aside the other pillars so that our investment review committee can actually make a decision on both the financial returns as well as the impact. So it's as key, and it's therefore fundamental to our philosophy. If we had the philosophy to have this documented, reviewed, and integrated in the decision making. We can skip to the next slide. I'm not going to walk through this slide in detail, but it actually just gives you a sort of pictorial representation of how this works ex ante. And this scoring that is done ex ante on the project side, on the market side, in terms of catalytic effects, is carried through into supervision. So as the deal actually is approved and materializes, gets implemented, we actually follow the project. If we can go to the next slide. We actually follow the project each year. We go back to the client. The development impact metrics that we choose to anchor our rating on is included in our legal agreements. We then go back to the clients on an annual basis, collect that information, and rescore ourselves for each deal every year during implementation. There's a certain period when we think that the project is operationally mature when we start that, and we do that till we actually feel that we've achieved all of the development impact of the project. Why do we do this? We do this because it enables us to recognize what we have done well and whether our ex-ante assessment is actually playing into account or not. It's a sort of self-accountability mechanism, but also for us to understand what types of deals make what types of contributions. If there are certain types of contributions we're able to make or not able to make, how do we then course correct where we can? And then last but not least, because we have this scoring system, it gives us a bit of a leeway to go back to our authorizing environment and say, look, we want to take a portfolio approach. We will do some deals which are perhaps not as rich on impact or perhaps not as large on financial returns as we would like. Maybe we're taking more credit risk. But when we look at it from a portfolio perspective, that we're able to balance these considerations much more systematically across the corporation. Last but not least, just to come back to Principle 8, all our ratings are actually performance audited every year. So when we put out both our ex-ante scores for the portfolio of our projects or the portfolio scores or the supervision scores for our portfolio, that methodology of scoring, applying these frameworks consistently in a sector across multiple deals is actually encoded in a procedural document. So our auditors actually go through that, take a sample of deals that we may have scored in the beginning that were just approved this fiscal year or this financial year. They'll also pull a bunch of deals that are actively under supervision and are being rated through the impact management framework, the AIM system, and and basically audit us and validate that, that we are using client provided information, that there is actually a record of this client provided information in our systems, that we are actually applying the methodology consistently. And then there is a disclosure of that in our annual reports. So we do like to see this through. We have a section that captures, as and when deals reach maturity. We do have a way to also track. Sometimes things happen in an unintended way, whether it's good or bad. And so we want to be able to capture that. That is also allowed through the supervision system. If we can go to the last slide. In addition to our deal-by-deal approach, we have a very, very much a real-time evaluation program that runs within IFC. It's a program that is meant to help our operational teams address knowledge gaps and answers either an analytical or a research question that will help our business to grow. So for example, we do take money from donors, and those are typical donor performance evaluations done according to good practice standards. Some of these are made available by our donor partners, et cetera. I'm not talking about that. I'm also not talking about the independent evaluation group that holds us accountable, that Ichido is a part of, that does routine evaluations, both of our transactions and at the sector level. In addition to these two elements, we have two types of work. We have our internal analytics and tools development program. So for certain types of investments, we don't have ready-made tools. So we create or help establish a framework that can be used. So for example, for projects that are doing nature-based financing, for example, we are looking at how do we look at these projects? How would we set up a system that we can then replicate across projects in this space? Similarly, we also do a lot of real-time impact evaluations. Some of these are rigorous, some of these are less rigorous. They may extend all the way from, for example, the internal analytics could also include portfolio reviews so that we learn and we know what we're doing well and where we need to improve. But our rigorous impact evaluations could be something where we are working with real-time investment clients to kind of say, okay, how do we basically look at the impact of what we have done with the client over a period of time? So these are typically done when we have some client buy-in. We're working with private sector clients, so we need to make sure that we are adding some value to the clients as well. We try to link these up with market research or questions or other learning questions the client may themselves be interested in. We've run a few, sort of quasi-experimental or more rigorous, we're trying to launch some more rigorous work in terms of doing evaluations and working with the client over a 2 or 3 year period. These are more, I would say, more customized, built around what our clients would need. And it depends also on the interest of our clients to participate in these programs. So this is just a little bit of an overview of what we're doing, and I'll stop here and turn it over back to you, Julie.
Yeah. Thank you, Deepa, for sharing a really robust example of impact management system and the evaluation. And I think all of the examples that were shared really highlight the fact that learning and improvement, really starts at the beginning of the process of the end-to-end framework, and needs to be really interconnected across and embedded into the design of the IMM system, and not something that you think about in the later stages. Given the time, we'll try to answer a quick question around what are the challenges that you're facing in learning and improvement, and what role do third-party evaluations or independent verifications play in your process? So it's 2 questions combined into one. If you can actually just go through the same order of speaking and answer briefly to those questions.
I think these days, in terms of challenges, we're finding that a lot more of what we can learn has been sort of expanding, because I think you're starting to see that a lot of the theory around impact and outcomes and what's being discussed at the academic level is starting to trickle its way down into the investment space. And I think in an attempt to sort of be more academically rigorous with what you're measuring through impact, you can be tempted to go down this path of, collecting more data to support that rigor. And I think doing so can actually have real-time domino effects on, one, your investment process and your investment team, and your portfolio company's ability to sort of collect that data and or operationalize it so that they can report on it back to you. I think it's important to sort of be mindful that, any additional thing that you want to learn about up here does have big implications sort of down the chain, because it does ultimately impact operations and processes. And I think for us, I'd say it's a lot like playing a logic game, because you want to find ways to sort of be as impactful as you can as an investor within the confines of sort of your mandate, your risk return thresholds and sort of the operational implications of the effects of trying to understand that impact as an investor. You know, for example, as part of this framework process, before we introduced sort of new metric sets, we actually surveyed our portfolio companies to see, one, whether they were already collecting the data but not reporting on it to us. Two, if they were collecting something similar, but what they were calling it something different. Or three, if they weren't already collecting that data, whether they would be willing to do that and how big of a burden would it be for them to actually operationalize it and send the data back to us. So there's a lot you're having to balance in that case. And I think that's sort of the exciting part about impact measurement and management within the context of impact investing. And in terms of the benefits of verification, you know, I'd say we actually used our most recent verification this past December to sort of kill two birds with one stone. You know, on the one hand, we not only wanted to comply with sort of the impact principles, but we also wanted to use it to solicit feedback from Bluemark, who was our verifier, on the design of the processes and the templates that were currently in development for our new framework. And so we actually found the process really additive in terms of how we ended up actually using some of their recommendations into the processes and templates as part of our new framework. And, you know, early on in this process, we actually spent quite a bit of time on the Impact Principles website to look at other people's disclosure statements to sort of get inspiration and feedback in terms of what we could and couldn't do with our own framework. And so that was really additive for us. And I think from an outcomes verification perspective, I don't know if we have full time to cover this, but we did recently engage 60 Decibels, which is an impact measurement firm, to sort of explore this relationship between, you know, end borrower sentiment about how they felt their use of credit was impacting, you know, individual business and sort of financial health at the borrower level. We did not engage 60 Decibels actually until we had already surveyed our portfolio companies to see, one, whether they were even collecting any sort of surveys or doing outcomes focused verifications on their end borrowers. The answer was a resounding no, you know, and the handful that actually did do it said that they were doing this as part of the 60 Decibels Microfinance Index, and that's why we sort of went down that route and engaged 60 Decibels to do that. One of the things we were trying to look at was to see if, for example, we could get anything out of comparing the 60 Decibels Performance Index for our portfolio companies compared to their gross interest rate return back to Microvest compared to the credit score that we were assigning them. And what we actually found was that if you were comparing the risk return threshold, it sort of follows on your typical risk return assumptions. But if you were actually comparing the two to the 60 Decibels performance, you know, it was less clear because we did have two portfolio companies, for example, that had identical risk return profiles, but wildly different 60 Decibels index performance. So one was a superstar in the 60 Decibels perspective, and the other performed sort of in the lower percentile. And I think in terms of, you know, being able to do anything with information, I'd say the sample size for us was too small to tell. We did look at data from 6 of our portfolio companies, and we didn't see enough of this sort of trend to set some type of end borrower scoring criteria or threshold for the portfolio. But what we are going to do going forward is we're going to explore ways to sort of increase the participation of our portfolio companies in the 60 Decibels Microfinance Index. That would, of course, incur additional costs, et cetera, or eventually sort of work towards encouraging the portfolio companies to sort of incorporate their own feedback element into their own processes. But of course, that's going to be more time and resource intensive for them.
Mm-hmm. Thank you, Lila. If you remember, the customer and investee feedback loop is one of the least developed areas in Principle 8. So a good example to share that. And I think cost of IMM and valuation is something that we are trying to figure out as a field as well. So why don't we go to Alice?
Sure. Actually, when we looked at the slide that you showed earlier, I saw unintended impacts and management of those. And actually, I would like to use that as a starting point to explain why I think that independent verifications play a huge role in the learning process of such a fund, as in our case also. Because we engaged Bluemark as well. It seems like we might have a biased view towards them as an independent verifier, but I also thought that engaging with them, and we did it twice in 2021 and 2023 respectively, and that their evaluation of our impact management processes and benchmarking those towards other funds in similar really helped us to further develop. And in this case, although we received relatively high marks across all of our impact management processes, they did highlight that this unintended impact management is also really important. And this is something that we're now just integrating this year. So yeah, this this is just a summary of kind of one example of how we further develop through a verification process. I'm sure there are many others, but this is something that really supported us in further strengthening our impact management progress.
Thank you, Alice. Luba?
Thank you. Without getting in details, there, I would say, two main challenges in maximizing learnings for us. First is a diversified investment strategy, right? From early stage, pre-seed, idea in the garage, all the way to buyout, middle market buyout, private equity strategy. Very different, may not be always applicable one to another. Timeline and nature of the business of investors is another limiting factor, especially when you do a credit strategy. Companies may pay out in full sooner, and you just lose the visibility to their impact. But that usually means a good thing, because we provided that catalytic loan that helped them financially to access general capital. And now the role of third parties, I double everything people say on impact audit. We're big fans, and we're going through impact audit now as we speak. But what I do want to highlight is interesting learning that we came to realize with carbon accounting third-party provider. That was a steep learning curve for us. We were engaged with a provider for over a year, and the learning that we made, that we actually do want to bring that skill set and the function of carbon accounting in-house. So we discontinued to work with third party and learned and trained internal person to perform carbon accounting ourselves. So that was something I wanted to share with the group.
Thank you. Really different types of impact auditing taking place, whether it's a practice, which is the case of impact principles, but we're also seeing data audits and impact performance audits, and some of the new development around impact performance reporting norm. I think it's positive for the field as well. Deepa?
So we've been doing verification for many, many years, right? So it's been, I think our verification processes started way back in 2004 when we first introduced a system that even predated AIM. I think the importance of verification has not lessened for these last decade and so, and that sort of attests to the importance of this principle. And the reason is twofold, right? I mean, we are a DFI, we have a certain degree of review processes for every one of our deals. We have an independent evaluation group that looks at our work, and yet we need independent verification of our results. And why? For two reasons, which is, one is there are client confidentiality clauses when we deal with private sector clients. And so when we look at some of our work, we want to always make sure that anything that we put on impact to the external world is verified. So there is a reporting angle to it. But there's also a learning angle in terms of management processes. Like, so every time we have a performance audit, it's kind of funny. We always pick up on some small or large things that we can do better in terms of either the guidance to our teams, how we are assessing impact on certain dimensions, which is constantly evolving, depending on what our stakeholders want, or when we introduce new methodologies, new systems, new rating tools. So it's been actually an important source of learning for us. On the challenges, I will just make 2 points. I think everybody sort of spoke to this, so I won't repeat it, that there are data challenges, right? There is a trade-off, and depending on the size of the organization and the level of sophistication of your impact measurement framework, there is a bit of trade-off in terms of the cost to the organization itself. And I think there's always a sweet spot to be found. And over time, we've found that technology has actually helped reduce that cost. The second thing is you also find the private sector itself changing and very much interested in the impact agenda. And so our clients, for example, know and expect that we would ask these questions. So when we put some of these data requests into legal agreements, it's not, many of them are actually already reporting on it in their annual reports or are interested in reporting on it. So it's a challenge to sort of also make sure from our perspective that we are on the top of our game, that we're pushing our clients to go that little bit beyond what they're doing. And so I would say for IFC, the challenge is a little different, which is making sure we want to do what we want to do, but we also sort of showing some leadership and moving the impact space, even for our clients who are doing this as part of their business. The last thing I would say, and I'll stop, I know that we're out of time, is that AIM is still proprietary, so it's not the tools and the techniques that we are using are, just to answer the question on the chat, are not exactly full. The system is fully open, but our specific benchmarks, etc., are very internal. However, having said that, I think we've advised several companies when larger corporations, when they've wanted to set up their own impact systems. And there was another question, I think, on whether we attribute these scores to ourselves. And on that, I just want to say the purpose is not to attribute it entirely to only what IFC is doing. We're just talking about the investment as a whole, of which IFC may be one.
Thank you, Deepa, for all of those thoughts. So with about 3 minutes left, let's do a lightning round closing remarks. And I would love for you to answer, what does it take to build a strong culture and system of continuous learning and improvement within your organization? What's your recommendation?
I think the first thing is to think about, with any impact management system, and at least for the ones that I've been involved in, I think it's a step-by-step process. When you're working with any kind of sort of a business partner, whether it's your client or your investment officer or your banker, I think one of the things for them is that it doesn't matter if your framework is not 100% all sorted out. What is important is transparency and clarity on the criteria for assessing impact. So I've found that usually if you say, okay, we're only looking at impact from the lens of X, and here's how you do it, that's much better than saying, we're going to look at these 5 different types of impacts, but it then becomes a very, very subjective decision. So I think I have learned that a little bit so taking it in steps, taking it in manageable chunks, and taking it in a very transparent, co-owned way, in fact, building it into the systematic review and decision-making processes of the organizations is probably the biggest benefit, is the biggest bang for the buck.
For me, three topics actually. One, prioritization. I think it needs to be fully anchored in the official commitment of a firm. It either be kind of with in your investment memorandum to LPs or in the regulation that your fund is anchored in, but full commitment to impact is required. Then second, resources. You need sufficient capacity. That's closely linked to what Deepa said. And you really need to bring in the necessary effort to fully integrate impact into the investment strategy. And then is the right incentivation, not only kind of those resources that work with it, but also kind of the investment teams to it, to make sure that everyone's aligned on maximizing the impact as well as returns.
Instead of pragmatic advice, let me just give you an inspirational thing to add us here. I would say just stay curious in your role, be intrigued with companies that you work with, learn what else is out there. The only constant in our work is that change. That's the only constant out there. So do not settle of what you are today. Keep on learning, keep on improving.
I think it's important to really get leadership buy-in into I&M, because I think without it, impact can get sidelined, especially if you're looking at it within this investment context where there are sort of these gray areas between those that see financial and business performance or indicators as sort of obvious proxies for impact versus sort of outcomes-focused indicators that can come across as extra work to your investment team if it's not socialized properly. And so I think, it is a big change management process. So having leadership buy-in is so critical. And I think if leadership is bought in, the resources will come.
Thank you. What a great set of takeaways. So, really ensuring leadership support and buy-in, integrating it throughout the business process, not just the impact process. And love the 3 takeaways around prioritizing, resourcing, and incentivizing. And Luba, thank you for that inspiration of staying curious in our work as well. Thank you so much for an amazing panel. And thank you to the AA team.
Thank you so much. Thank you for joining.